So for today, we're going to be using Fidelity to show you exactly how I go about investing in the simplest and most efficient way possible. Now, Fidelity is a very good site to start with, but there are a bunch of great reputable online investing platforms like Vanguard or Ally that you can check out. What I'm going to show you today will apply to any major investing website that you use. Now, before we get started, the very first step from my experience in investing is actually making a decision. And that decision is, are you an investor or are you a trader? And both of these are very different investing styles. First, an investor is someone who has a long-term outlook of the stock market. So they're likely going to buy and hold a stock or funds for years. They're seeking larger returns over a longer period of time. They're either saving to build wealth for retirement or possibly to even pass on that wealth to other people in their family. And they likely invest in mutual funds, index funds, or ETFs. And don't worry, I'll explain all these later on if you don't know what these are. Now, in contrast is a trader. A trader is someone who has a shorter term outlook on the stock market. They're buying and selling stocks daily, weekly, or monthly. They're seeking smaller returns over a short period of time. They're investing to generate income or as a side hustle. And they likely invest in individual stocks, bonds, or ETFs as well. And then for those who are interested in being traders, there's several different types and methods. There's a day trader. This is someone who is buying and selling stocks every single day. And then there's a swing trader who's buying and selling stocks every week, every 2 weeks, or maybe even every month. And then there's different methods to being a trader. So one method is called technical analysis. So technical analysis is a trading discipline employed to evaluate investments and identify trading opportunities and price trends and patterns seen on charts. So this is essentially someone who's looking at the chart patterns and trends of a certain stock or a fund and trying to decide when and where should they sell or buy or hold. Then there is fundamental analysis. Now, this is someone who looks to see whether an investment is overvalued or undervalued based on underlying economic conditions, as well as the finances and other factors of the company. So this method pays attention to a company's earnings or how the economy is going to impact the price of the stock for that company. Now, there is so much more that we could dive into from here, but today I really want to keep this simple and practical. Now, if you do want more in-depth details, then definitely like and subscribe, because that is how I know that you like this type of content and that you want to know more. Now, today we're going to follow the path of an investor, because personally that is the path that I am well versed in, and that's the path that I've decided to go along. I have bought and sold stocks as a trader, but I can share more about that experience in another time. Now, with all that out of the way, you're back on fidelity.com, and what I'm going to show you today is completely free. You may not even need to create an account to do any of this. So once you're on fidelity.com, you're going to go to news and research. Then you're going to go down to mutual funds. And I'll explain why we choose mutual funds in a second. First, what you're going to do is going to leave this as all class, all categories. And then what you're going to do here is we don't want anything too expensive, so we're just going to choose minimum investment of $2,500 or less. You're going to do all for management approach. And for what's called the Morningstar rating, I would say you start at a 4 or more stars. And for right now, we're not necessarily going to worry too much about the returns and the expenses. And then now it narrows it down to 566 funds, so we're just going to hit view fund. So now you're on this page with hundreds of different mutual funds to choose from. And today we're going to focus on mutual funds, index funds, and exchange traded funds, or ETFs as they are called. Now let me break it down just a little bit so that you know what these different funds are. So mutual funds are a professionally managed investment fund that pools money from many different investors to purchase securities like bonds or stocks. So basically, instead of buying one stock or bond, a mutual fund has a bunch of people who put their money into the pot, and then a fund manager decides on what to invest in. The main advantage of mutual funds is that this gives you diversification, because you're not just buying one stock or bond. Now, on the other hand, index funds is a type of mutual fund or ETF with a portfolio constructed to match or track the components of a financial market index. So for example, there's the S&P 500 or the NASDAQ, and an index fund is meant to match or track the performance of those indexes. So whatever the S&P 500 does, or whatever the NASDAQ is doing, whether it's going up or down, an index fund is following that same exact pattern. Lastly, an exchange traded fund, ETF, is a type of pooled investment security that operates like a mutual fund. Typically, ETFs will track a particular index, a sector, a commodity, or other asset, but unlike mutual funds, ETFs can be purchased or sold on a stock exchange the same way that a regular stock is. So what that basically means is that an ETF is traded just like a stock, so like Apple or Netflix, and it's going up and down in price every minute, every second, as opposed to a mutual fund where it isn't until the end of the day that you will see the actual final price of that fund. Now you might be wondering, okay, why are we only focusing on mutual funds, index funds, or ETFs? And why are we not talking about things like Tesla or Apple or these types of individual stocks? The reason is because of the number one rule of investing, and that is diversification. So diversification is the process of allocating money in a way that reduces the exposure to any one particular asset or risk, or as some may call it, don't put all your eggs in one basket. So diversification is really important because it reduces your overall amount of risk. Now, of course, there are people who trade individual stocks and do that every single day, but again, that's a whole nother conversation. I'm just really showing you the process that I use that is the most efficient and has the less amount of risk. Now that that's all out of the way, let's jump back into Fidelity. So now you have this list of a bunch of different stocks here on Fidelity, and so how do you narrow down and figure out the ones that are going to be the best ones for you? First, what you're going to do is go down to fund features, and one of the first things you're going to do is click on inception date. So inception date is essentially how long has the fund or stock been around. And so what you want to do is you want to find ones with a lot of experience. You don't want something that's only been around with one year, 3 years, or 5 years and doesn't have a lot of history. So you'll do the oldest, which is 10 years or longer, and you may also consider doing 5 to 10. At least from my experience, you really want something that's 10 years or older, only because it shows you how it has performed throughout a variety of different economic situations. Now you'll go back to the fund features again, and you'll click on turnover ratio. So let's talk a little bit about turnover ratio. The turnover ratio, or turnover rate, is a percentage of a mutual fund or other portfolio's holdings that have been replaced in a given year. So essentially, a turnover rate is basically how many times in a particular fund, if they have Apple, Google, Nike, how many times are they taking those out and putting new ones in? Or how many times are they buying and selling constantly? So how many times are they turning over the particular stocks that they have in their portfolio? So for example, a mutual fund that invests in 100 stocks and replaces 50 of those stocks during 1 year has a turnover ratio of 50% because it took out 50% of its stocks over a given year. So really quickly, what you really want to do is you want to look for funds that have a turnover ratio of below 25% and even at maximum 50%. This means that they're not constantly in and out of the market, pulling their stocks and their funds in and out all the time. Okay, now you're going to continue to go down, and the next thing that you want to focus on to narrow things down a little bit more is the net expense ratio. So the net expense ratio reflects the percentage of a mutual fund, an ETF, or index fund that is set aside toward a fund's operating expenses and fund management fees. So it's basically a list of fund expenses minus their brokerage costs and sales charges and all that. So essentially what you want to do is you want to keep the net expense ratio at maximum of 1%. So what I would do is choose 0 to 5 and 0.5 to 1. And then you're going to hit go. So there you go. You've narrowed it down even more. Now we only have 62 matching mutual funds, which is really helpful when you think about it, because sometimes if you have over 500 or 1,000 different funds to choose from, it makes it a little bit more difficult. So now the next step that I would do is sort this by 10 years. What you want to see is which stocks are performing the best within a 10-year period, because you're going to really see historically how they have done. So we still want to narrow this down even more, and the way that I do that is by looking at its category. So here you'll see there's technology, there's large growth, there's health. And so what I use is not only their category, but also their market capitalization. So let's talk about that a little bit. So market capitalization is the value of a company that is traded on the stock market, and is calculated by multiplying the total number of shares by the present share price. So really quick, just to break this down a little bit, there's a variety of different types of market capitalizations. And so first I want to talk about a large cap. So when you see the word large, that usually means large capitalization, and that refers to a company with a market capitalization value of more than $10 billion. So this is your Nike, your Google, your Tesla. The next one is mid cap. And mid cap is a term given to companies with a market cap between $2 billion and $10 billion. Then there's small cap, which is a public company whose total market value is about $300 million to $2 billion. And then finally, there's also what's called international or global funds. Now, these are stocks or bonds that are traded overseas. So this is yet another category that I pay attention to. And the reason that I pay attention to these types of different categories is because of what's called diversification, which we've talked about already. By paying attention to these types of categories, it further diversifies your portfolio. So you don't necessarily want to put all your money into large cap, or put all your money into mid cap, or put all your money only in US stocks. So essentially that's what I like to do, is put it in these types of mixes. So for example, let's take a look at this one, FOCPX. The category that it's on is under large growth. Now, this basically means that it contains companies, which are also called holdings, that have a large capitalization, and the fund is focused on growth, which means that it is investing in companies that are projected to grow faster than other large capitalization companies. So this is your Microsoft, your Google, your Apple, as just an example. So those are the types of companies that's going to be within this fund. And then I go over here to its performance over 10 years, and it's had an 18.20% return over a 10-year period, which is very good. Now, you might say, well, why not go by the life of the fund? The issue is, if you go by the life of the fund, what happens is it only goes up to however long that fund has been in existence. So for example, this fund over here, yes, it's at 16.77% for the life of the fund, but it has not been around for more than 10 years. So that's why I go back to using a 10-year period. Now let's continue on and see that the fund that we were looking at before, which is the FOCPX, it's a large growth. It has a good 10-year performance, and then the net expense is 0.8%, which would be under our 1% threshold. So now let's open up this fund and get some more information about it. So I have it open right here, and again, just to recap once again, it has a good 10-year performance. It's in the large growth category. It's been around, as far as the funding inception, has been around since 1984, so it has a long history. Its expense ratio is 0.8% once again, which is under 1%. And then its turnover ratio is 29%, which just means that over a calendar year, only about 29% of the holdings or the stocks that are in this fund are being switched in and out. So it doesn't have a lot of change. That means that there's confidence in the stocks or the companies that are in this fund. And then one of my favorite parts about this is $0 to invest. So you can invest in this fund with $1, with $2. So it's not very expensive. If we scroll down here, we also see its holdings or its companies, the stocks and bonds, for example, that are within this fund. So the top 10 holdings are Microsoft, Apple, Alphabet or Google, Amazon, Meta. So again, these are the major large capitalization companies that we were talking about before. Now, one of the most important pieces of information that you want to look at is how does this fund compare to the S&P 500? And I'm going to show you exactly how you compare it. But before I do that, let's briefly explain what the S&P 500 is if you don't already know. So the S&P 500 stands for the Standard & Poor's 500 Index. And basically this is a stock market index of the 500 leading publicly traded companies in the US. The S&P 500 has existed since 1957, and it acts as a benchmark of the performance of the US stock market overall, dating back to the 1920s. So the index has returned a historic annualized average return of around 10.5% since its inception in 1957 all the way through 2021. So the S&P 500 is commonly used as a benchmark to compare funds because of its long history. So now let's go back and take a look at how you would compare this fund to the S&P 500. So when you're on this page, you're going to go to compare, and then it's going to pop up this window, and you see the fund that you are interested in looking at. And then if you scroll down here, this blue line is going to be the fund that we're looking at, and then you can actually compare it to a particular index. And we're just going to select right here the S&P 500. What this chart is showing you is a hypothetical growth if you invested $10,000 10 years ago. So as you can see, this fund has been performing pretty well, actually very well against the S&P 500. And if we go all the way to the 10-year mark, it shows that after 10 years, if you had just invested in this fund with $10,000 and added nothing else, you would have $53,237 in this fund versus the S&P 500, which would have $36,428. So this is just to be used as a benchmark. This doesn't mean that this fund will always be better than the S&P 500, but it gives you a sense of, okay, over a 10-year period, this has performed fairly well. So it just is, once again, another factor for you to take into consideration as you're choosing a mutual fund or an index fund. Now let's go back to the list, and again, don't want to continue to just repeat the same thing over and over, but I just want to just show you it's the same principle. As you go back and you look for some other funds, for example, this is an index fund. So this is a NASDAQ composite index fund. So that's a little bit different than a mutual fund, which we already covered before, but let's take a look at this one. So it's in the large growth category. We've already talked about that. It has a 16.55% return over 10 years, and then its net expense is 0.29%. So once again, these are all different things that we use to measure, is this a good fund to invest in? So let's open up this fund to get more information. And again, really quick, once again, a great 10-year performance overall. It's been around for more than 10 years. It's in the large growth category. Its turnover ratio is very, very low because this is an index fund, and all that it does is it is matching the performance of the NASDAQ. Whatever the NASDAQ is doing, if it goes up, this fund goes up. If it goes down, this fund goes down. And my favorite part, the minimum amount to invest is $0. So once again, we won't recap this all again. Let's go over to comparing it. So we take this, and again, we could compare it to the S&P 500, and you'll see once again, overall in the last 10 years, this one has performed better than the S&P 500. Again, this is not telling you that you need to choose this one specifically, but what I'm just showing you is these are the tools that you can use to make reasonable decisions about the funds that you invest in. So it isn't gambling in any kind of way. So this is essentially the same step that I take with every single fund that I look at, whether it's an index fund, a mutual fund, or if we go down here, you'll see there's some mid-cap funds, there's going to be small cap and all that as well. So that's just to give you an example of overview of the way that I do it. So let's do a quick recap to make sure you're understanding these concepts. So first, the two main aspects of investing is diversification and managing risk. And the way that you do that is you invest in things like mutual funds and index funds or ETFs, because they have multiple companies that they're investing in as opposed to just one or two companies. Then you choose companies with a strong performance over 10 years or more. Then you want to look at their turnover ratios. How often are they taking out and putting in new funds? And you want that to be low. And you also want the expenses to be low so that you make the most amount of money in the long term. And finally, you further diversify by investing across a variety of different categories: large cap, mid cap, small cap, international, and global funds. So that's just a short recap. But again, the more and more that you do this, the more comfortable that you become. Now, before we end, we need to talk about the Roth IRA. There are so many options of what to invest in, but the Roth IRA is one of the best options, especially if you are young. Now, what is a Roth IRA? A Roth IRA is an individual retirement account that offers tax-free growth and tax-free withdrawals when you retire. The reason being is you pay taxes before the money goes into your account. So other retirement accounts like the traditional IRA will charge you tax when you finally withdraw the money. The Roth IRA does not do that, and the money that grows is the money that you get. Now, the Roth IRA is set up for you to withdraw from it once you are 59 and a half. Now, and you can open a Roth IRA account as long as you are earning income. Another thing to tell you is that there are limits to how much you could contribute to a Roth IRA within a given year. So if you're 50 or younger, you can contribute up to $6,000 within a given year. But if you're 50 and over, you can contribute up to $7,000 within a given year. And what's really important is to invest in a Roth IRA if you are young. So if you're in your 20s, for example, or even your 30s, start investing in a Roth IRA and you'll see the money grow over time. So whether it grows to $100,000, $200,000, or even $1 million, that's the exact amount that you're going to be able to withdraw at 59 and a half. So the Roth IRA is a great investment idea if you are looking to invest for the long term and want to get the most out of your money. Now, before we end, I'm all about practicing what I preach. So what you're looking at right now is one of the accounts that I have, which is a Roth IRA account. And you can see some of the things that I'm invested in. And of course, I'm not telling you to invest in these things, but this is just using the method that I've just shown you. These are the things that I'm invested in. And because I have a long time horizon, and I know that I'm going to be investing for 5, 10, 15, 20, 30 years, I'm not worried because I feel confident that these stocks are going to increase over time. So that's what I wanted to share with you today. I hope that was helpful. And if you want more content like this, then please like and subscribe and check out the links in the description to support the channel. There's so much more that can be said, but for now, keep educating yourself and making money in the most efficient way.